Good evening. This is Ken at Tortoise Capital with a review of the weekend trading report for August 17th, 2019. Markets in bullish volatile conditions. It's worked its way back into neutral for all the look back periods except for overbought on the minus 270. So some evidence of stabilizing, especially when you look at the risk Z, has rolled over. It's starting to creep back up into the spring here after an excursion to minus 2.5 Z. That's starting to favor long side swings. Theoretical exposure in ETF2, though, is at 0%. Everything's below its 4-month moving average. You see the current holdings for August, and then the leaders based on Friday's prices. So a lot of defensive plays currently. I'll just highlight the... I've been doing the emails and blog style postings at the Patreon page for trade quizzes and mini lessons. And that will be the long-term plan for supporting the work at some of the lower levels of frequency. Quick look at some of the BMR portfolios, mostly cash. The defensive plays are the clear winners. Consumer staples is holding up really well. Real estate holding up really well. ETF 32, 3/4 still on a cash signal. Gold, technology, utilities, and again staples. In the Dow, it's Procter & Gamble has really been immune to the sell-off and looks pretty good. They're standing out nicely. Walmart doing pretty well. Weakness down here in GE, Pfizer, Walgreens, 3M. Cisco and Chevron both got smashed this week. Sector spiders, it's the defensive plays once more, and a little bit of technology. Real weakness in energies, metals, and mining, and the basic materials. Gold's starting to give back some of those big gains. I think that run may be done. All the indexes below their 4-month moving average puts into maximum defensive position on the position trading. Got to respect that. Bullish volatile, S&P at 52 is better than EFA at 44. Emerging markets, Latin America, the weakest. U.S. large caps and tech, the only thing above average among the indices. Energy getting crushed, and staples and technology otherwise holding steady. Again, defensive plays, and Brazil sneaking in. Green and white are the ones I really like to see. It was good, now great, and a chance to exploit some new strength. Silver, and then the bond funds. Weakness is white and green. Was great, now just good. Preserve profits and watch for resumption. So that would be tech and staples. I agree on both of those, that if we get any kind of bounce, it's going to come from there. Shift into the daily. Just notice how non-directional this has been. Still in the lower third of the 10 and the 30-day look-back period. Big range day again today. There's the mechanical frame. Finished the week lower than Monday's opening, so that's a sign of weakness and the fact that we're still deep in the winter. Although you can now start stocking for spring here. This is very vulnerable. All it takes is one tick below this double bottom, and it starts crashing again. Cisco, Pfizer really just getting smacked around. Lots of auto framers to choose from. Today was actually a relative doji day in the Dow 30. Some breakouts to the upside in Verizon, Coke, and Procter. McDonald's and Walmart had been leaders, but suffered somewhat today. ETF 30, fewer dojis, fewer auto framers, but still a respectable number that can be worked. Defensive play and utilities really stood out today. And consumer staple. A recurring theme. Lots of large negative Z-scores here on the big percent losers. Again, comes as no surprise. The big directional moves is what it takes to get this kind of a Z-score that high. And when you look at Pfizer, you'll see why. Microsoft and McDonald's showing persistent, stabilizing lack of volatility here. Auto framer, lots to choose from. The usual suspects in the top shelf. These are the symbols most ATRs below their own RL 270. So Pfizer 6.5 ATRs below fair value. Cisco at 5. Bottom shelf in the red. These are the ones that are beyond their fair value in terms of ATR. So all the defensive plays showing the way there. Daily squeezes had relatively narrow ranges today compared to their range stats, so you get a large multiple if you get a mechanical entry. I'll be looking at Visa and IBM for sure. Win, our frog champion, is postured well. Intel and Boeing have both been paying off on intraday trading with large ranges as well. Again, tons of winter. Some rolling into spring, though. Today's price action now starting to generate some spring. Consumer staples, Mexico. Multi-time frame index summary sorted by the inverse 10-day look back. Verizon, Coke, and Procter all leading the way. Suffering in Chevron, Cisco, and Pfizer. Yeah, this my little golden jackal here that makes me feel like I'm trying to scavenge off these bottom feeders. That's why I've sorted it by the 10-day inversely. The lack of any red here in the ETFs suggest some stabilizing factors in play. Looking at some market mosaic here. 30 is still sloping deeply down, more than 1 SD below the long-term average. Finding some stability in here, though. And this would be a natural place for this to start to roll up, and you can already see it starting to happen. The polynomial regression line starting to find support. It takes 1 or 2 more days to start curling up, and belief will come back into this market. Long-term volatility still peaking. The 10 has rolled up. The 30 starting to roll up at this natural 2 sigma limit. The 90 has come back to normal. This would be a typical pullback period. I mean, the last time it pulled back that far and stabilized just below the river, it then gave us one of these. And the time before that, it gave us one of those. So it's not impossible. Although, since that's an all-time high right there, I just don't think there's that much room to the upside. too much negativity in the market right now with the China's trade war that really made the administration blank. So there's not much help coming from the Fed. So you wonder what it takes or what we have left in the tank to be able to get up there through that. I'm more worried about the downside right now. And that's a quick look at the market. I still think it's a market direction issue right now, although we're starting to see a few candidates for upside strength. But really, pick your downside targets and be ready to exploit. The upside strength is in the defensive plays right now, like real estate, precious metals, and staples. Technology could creep back in though if we get a few more days of support. This is Ken at Tortoise Capital. Keep your risk measured and your powder dry.